Welcome to the YFP Real Estate Investing Podcast. I'm Nate Hedrick.
And I'm David Bright. We're both pharmacists and real estate investors that believe that real estate investing does not have to distract from a meaningful career in pharmacy.
Each episode, we share stories that educate and inspire pharmacists to leverage real estate investing as a part of your financial plan. Hey, David, how's it going?
Hey, good, thanks. How you doing, man?
Good. It's fall. We've got the market sort of winding down. In some areas, it's a little crazy, but it's starting to feel that way. How's everything going for you guys?
Yeah, no, fall is quickly moving through. It's getting real cold up here. So I don't know. In January, I won't say it's real cold yet, but like right now, it feels cold, and it's the market cooling. Also, it seems like at least what I'm seeing in my area, I'm curious if this is what you're seeing, but it feels like that traditional fall time where a really great house that's priced really well is still going to move quickly because there's still people out there buying, but there's not as many people buying. And so if it's not a great house, if it needs some work, if it's not priced well, that's where it starts to become problematic to sell a house right now.
Yeah, I think that's pretty accurate. And again, I'm sure there's other areas that maybe are seeing different things, but for us, yeah, that's 100% right. I've got buyers right now that if the house isn't like exactly what they're looking for, they're just saying, I'll wait till next week. Something else will pop up, so it's interesting.
Yeah. And I should say too, like when we were looking at a house back in like 08, 09 and stuff sat on the market for months, that was like normal. And so now it feels like it's sitting for a while if it's sitting for 3 weeks, so it's still in the overall grand scheme of things are still moving. It's just not the breakneck pace of like 2022, 2023 anymore.
Yeah, I think anytime you compare yourselves to a year or two ago on things like interest rates or things like the market, it's easy to kind of jump into this fallacy of like what normal actually was because it's not been normal for like 3 or 4 years now. So.
Yeah. And I think one of those not normal is the price of the house. And we've seen list prices kind of all over the place and continuing to climb, maybe even beyond what the market will bear in some cases. And I heard someone recently say that the greatest lie in all of real estate is the list price of a house, because that's kind of that variable that has the least to do with what the house is actually worth is the list price, right?
So it's really cool that you mentioned that because one of the things I say to every single one of my clients is that list price does not matter. It is completely made up. And there's truth to that. Like it does not affect the actual market value of the house. List price is literally something that the agent and the buyer or the seller, get together and they decide on a number. And that's how you make up list price. It has nothing to do, hopefully, almost nothing to do with market value. So when someone talks about paying 10,000 under or 10,000 over list price, like, okay, but you're 20,000 off a number we made up anyway. So yeah, I think that's super accurate and really important to highlight.
Yeah, there was a house not far down the road from where I live that sold earlier this year for almost 50% over list price because they just priced it so low to get an incredible amount of traffic. And it worked. It got a huge amount of traffic in a bidding war and it bid it up. So yeah, it feels odd because people are used to, particularly in the investing space, right? People are used to, oh, that stock is worth this because that's what it's trading for in the stock market. And that list price that I see must have something to do with the value. Maybe I see something where I think it's going to go up or down, but for a lot of investing, people are used to the list price has something to do with the actual value, right?
Well, and think about our day-to-day life. Even like if you go to the grocery store, right? You're not going in there and seeing a $3 gallon of milk and going, "Oh man, I hope I can get that for $5." Like I got to bid when I get to the checkout. Like it's such a weird concept for us to see a listed price for something and then to go and not spend that anyway. It's an odd concept that only really applies to real estate.
Yeah. So I think with that, it really begs this question. How do you know what a house is actually worth? And how do you use information that's out there to help you make a decision about that so you can make an offer on a house and so that you can hopefully get a house at a reasonably good deal, particularly if you have an investing hat on?
Yeah. And so like we do on every couple episodes, right, a deep dive on a topic that we think is important or we think that would be helpful. We thought we'd talk about, the idea that if markets right now are sitting with lower inventory or sitting there with strange pricing, maybe there's houses that are sitting on the market, right? There's just a chance here to really start to take a look at that and see, is this something that we can talk about? What is market value and how do you assess that?
Yeah. And Nate, I know in talking before the show, you and I mentioned that there's a few considerations when we're talking about the value of 1 to 4 unit residential properties. And that's one of them is what goes into this formal appraisal for a 1 to 4
Mhm.
unit property. How can you predict what will change about that appraisal following renovations? And then how can you leverage that prediction of value for the 1 to 4 unit residential property when you're making an offer? So I think it's probably important to start with the appraisal itself.
Mm.
But since I've used the word 1 to 4 unit residential like so many times now, Nate, can you just start us off with like why am I hyper focused on that? Why does 1 to 4 unit residential differ from so many other real estate products out there?
Yeah, we've talked about this in the past where 1 to 4 units are considered, even if they're multifamily, right? If you're talking about triplex or a quad, yes, that's multifamily, but it's considered this small multifamily. And from a loans perspective, from an appraisal perspective, that's considered to be, this like smaller loan type, right? It's a single family or 4 unit or less type of loan. And so that's just because it's not considered apartment building, because it's not considered true large multifamily, they're treated differently, right? They follow a residential set of loans rather than a commercial set of loans. And so because of that, they kind of get grouped together into this one bucket.
Yeah, and really for the sake of this podcast, it seems like most investors at least get started in the 1 to 4 unit residential realm because it's pretty easy to get your feet wet. It's a much lower price point. It's so much more familiar. If you're buying a single family house and you've already bought a single family house to live in, there's a lot of similarities in that process versus if you're going to go out there and buy a larger commercial multifamily or you're going to buy a storage unit complex or something like that.
Mhm.
Those tend to be much higher price points, completely different complexity, completely different loan type, those kind of things. So,
Yeah.
with that, then the appraisal with your realtor hat on, I'm sure you've seen a bunch of appraisals go through, some of them that you agree with, some of them that you don't agree with. But at least what factors, what data goes into an appraisal in the process of purchasing a home? And why does that appraisal value matter?
Right. So if we start with like that appraisal, like why is it being done, right? So typically the bank is the one that is ordering the appraisal. This is the person who is basically paying for the house, right? They're lending the
Mhm.
bulk of the money for that property, and so they want to find out what the market value is. Like I said earlier, the list price is sort of meaningless. So they want a independent third party to come in and say, hey, I looked at the property, I think it's worth X. And so determining that X is kind of the point of the appraisal. And so the things they look at, they start with location, right? It's got to be nearby, usually within a half a mile, sometimes even within a quarter mile if it's a particular city street. But generally within a half a mile or so. They want to look at things like the school district that property is in, right? So if I'm right on a dividing line, even though a house is zero point 0.1 miles away, if it's a different school district, that could dramatically affect the appraisal. So you're really looking at location first. Then you're looking at things like size of the house. So think square footage, specifically above grade finished square feet. That's big, above grade. If you look at like the Zillow or whatever square footage, it's usually everything, including like basements, and so that's not what an
Yeah.
appraiser is going to look at. They'll look at bedroom and bathroom count. They'll look at acreage of the property. That's lower on the list with sizing, but it's still a factor. And then they'll look at things like the actual age and condition of a home, right? So when was it built, right? Was it pre 1950s or after? Was it pre 1976 or after? Because those affect different things with like lead paint or materials that were utilized. And then similarly, like what is the condition of the home? They actually have a whole rating system for this. It's a C1 through a C5, with 1 being it's a brand new home, 5 being it's essentially falling down or near enough. So you have some sort of scale of where that property's at in terms of condition. And so all of those factors, amongst a couple other small things, are what an appraiser looks at to determine market value of a property. If it was on the open market, what would it sell for?
And that's really taking those data points and comparing them to other houses that have actually sold in a shorter time range, right? Generally last 3 to 6 months, maybe 12 months, but comparing it to other sold houses, not just other houses on the market for sale or other things that have sold off market, those kind of things, right?
Yeah, and I guess we should clarify, like, this is the ideal state, right? What you
Mm-hmm.
want is everything I just said within the last 3 to 6 months. That's not always easy to get. I mean, imagine something that is a rural property on 10 acres and the neighbor is, already a half a mile down the road, right?
Right.
That's not going to
Right.
be viable everywhere. So you have to kind of get creative with some of this. But yes, ideally within 3 to 6 months, if there's houses that are on the market, they might use those as like pseudo comps. I've even had cases where I've got houses that are pending and the appraiser will call me up and say, "Hey, I saw your listing is pending. Can you share with me what the property is selling for, what you have a contract price for?" And we have to get permission from the seller and all that stuff. But like,
Mhm.
there are ways to kind of get creative if the ideal state isn't there, but there is this sort of golden rule if you can get there.
Yeah, one of the first houses that my wife and I invested in was a condo, and it was in this big condo complex, and they all had the same layout, they all had the same square footage. A lot of them had even the same finishes, and so it felt really easy to compare because I could look
Hmm.
at the last five condos that sold, all right about the same price point, and know it's probably going to be right about there too. But you're right, in a lot of areas, it's not as clean and easy. There's not like a street of two-story brick houses that are all built in the same year and that kind of thing. Sometimes it gets tricky, but with my pharmacist hat on, that feels like a math problem. That feels like a data thing, which is like oddly comforting to a pharmacist because like we can do math, right? So there's got to be a way to do this, right?
Yeah, and it's funny you say that because when I sat in my like real estate classes 7 or 8 years ago now, I love this part, like how to appraise a house or how to, because I was like, this is it, like just like pharmacy school, man. Like throw me the data and like I can
Hmm.
figure out the
Hmm.
math behind it. So yeah, I personally like it. And something to keep in mind too is that like this is not a perfect science, right? This is an opinion of value, and actually when you look at an appraisal report, it will say, Nate, if they're the appraiser or whatever, Nate's opinion of value for property X at X and Y date. And it's very clear, like this is the opinion of value I have in this exact moment, and it could change tomorrow because based on different factors. So like it's a one-time snapshot into that value, and it's just one person's opinion.
Okay. But the appraiser's opinion really does matter quite a bit though, because that's generally what the bank's going to go off of. We could have our own opinions as buyers and sellers and things like that. And admittedly we can get emotionally invested and want to like fudge it a little bit because, oh, this is so nice. What if we could do this? What if we could, like, maybe it could be worth that, right? Like that's a common temptation as a buyer or a seller to kind of stretch that. But sometimes realtors can help that, right? Like realtors will occasionally do BPOs and things like that. Can you explain what that is?
Yeah, so a broker price opinion. So it's similar to an appraiser, except that the broker is not a licensed appraiser. So it's a different type of license that we get to become an appraiser. I am not one. There are only a relative handful in every state based compared to the number of real estate agents that are out there. And so if you ask for a broker's price opinion or a BPO, basically it's a real estate agent's take on that, and it might be something that where either an appraiser is not available or you want to have a property listed for sale and you want to start by getting the broker's opinion on what they think the price will be. Sometimes banks will ask for this, especially if they are like a real estate owned or REO property where they've taken a property and they've foreclosed on it and now they own it, rather than going to a full appraiser. The bank will go to a broker and for a much smaller fee can get the broker's price opinion of like, hey, if you were going to list this bank, I would list it at 200,000, and here's like why I think that. And so they're not as formal. They're really just based on an expert that works in that market, kind of giving they're not appraiser based opinion, but they are an option for certain things.
Yeah, and it may be a close way too, where if you are looking to buy or looking to sell, you can ask your realtor, and realtors often, particularly if they operate in that area quite a bit, they're staring at these numbers all day long. They could probably have a pretty good idea of value and be a nice safety check so that if, as a buyer or a seller, with your investor hat on, if you're starting to get more attached or questioning your objectivity in this, getting a realtor involved can be really helpful there.
Yep,
What
for
about the
sure.
AVM? I keep hearing more about AVM in the process too. Can you help us through what that is?
Yeah, you'll hear more about AVM, especially if you're in the market for refinance right now. So we're
Hmm.
actually going through this on a HELOC at the moment, where we are getting a new HELOC on our house. It's gone up in value, so wanted to bump up our HELOC. And rather than actually send out an appraiser and spend the money to hire somebody, they use the AVM. And AVM is basically like, I almost hate to say this, so it's automated valuation model is what that stands for. It's almost like the Zestimate, right? So it's a computer model that is essentially guessing as to what the price of that property is worth. It's a conservative one, right? I think the Zestimate is kind of the opposite, right? They built it to kind of keep pushing the values up. AVM is like the bank's version of this AI computer driven model that is more conservative in its estimates. But a lot of times, if you go to refinance or purchase a property with a large amount down, they don't even have to hire an appraiser. They can just use the AVM and say, "Yeah, it's coming in at 300,000. Like you're good. It's high enough. Like we've got all this equity built into the house. We don't need to bother with a full appraisal." So it's one tool in the toolkit, but you probably only see it with like refinances or HELOCs.
Okay. Okay. So on the hierarchy, it sounds like the appraisal is the one that matters the most because that's the one that the bank is going to use. The BPO or the realtor's opinion is pretty significant in there. AVM is okay. It sounds like you're not so in love with the Zillow Z estimate then. Is that true?
I'm not a Zestimate fan. It's just this estimate can be right, right? But it's just like anything in pharmacy, right? We don't just use one data point to then evaluate a drug or evaluate a study, right? We have to have a lot of data sets behind it. Zestimate is getting better. I still don't like relying on them. They're trying their hardest, I suppose. But they like to push values. They like to basically make it up for whatever purposes. The thing I always laugh about is like if you look at a house that like before it's listed, it'll have some Zestimate. It's just like some made up number. Then the house will sell, and all of a sudden the Zestimate will update to like exactly the sell price. And like, okay, duh, like now it's right, but it's going to be wrong again in 3 more months. So it's just their model is what it is, and it's not something to be relied upon. There's a reason that no bank has ever loaned on Zestimate. It's not accurate.
Well, and I think it's fair to some extent too, because when you look at a house with an investor hat on, oftentimes you're looking for what that value is, and you're trying to get an idea. So if you're looking at what other properties have sold in the area, as you're doing that, you're inherently looking at pictures too. It's not just stats, but it's looking at the condition of the house. How does the roof look? The furnace and water heater, are they
Mm-hmm.
from the 1960s or are they updated? You know, what's going on in that house? And that helps you to determine that value a little better, particularly if you're working in a specific area. And a lot of investors that I know try to invest in a smaller radius so that if you're investing in an area where you do, for instance, single family rentals, typically 3-bedroom houses, and everything in that area is a 3-bed, 1.5 bath brick ranch with a 1-car detached garage, then you start to get good at understanding those because you're following the sales. And that's just as an investor might do that, that's something that a realtor can do, and then also look for anomalies in that. Is that right?
Yeah, absolutely. I mean, if you're working with a good agent and you're seriously considering an offer on a property, I think, asking them to do that extra step of like, hey, what is this worth? Like, what do you think the value is after looking at these pictures? That's a huge step. I mean, that's something we do anytime I'm putting in an offer. Now, I'll caveat that with one good way to burn a realtor bridge is to ask them to evaluate a dozen different properties, right? Like this is a pretty labor intensive process. So it's something we want to do only more when we actually like a house and ready to put an offer on it. But it's very normal part of the process.
Yeah, but if you're looking at a neighborhood of 3-bed, 1.5 bath, 1-car detached garage brick ranch houses, and it's in the Midwest, and they're all $200,000 all day long, and then you see a list price at 220, and you see a list price at 160, you can start to then look at those anomalies and see if you can figure out why. Like maybe the 220 is super remodeled, and maybe the 160 needs a lot of work, and so that's how you can start to look for maybe there's a deal potential to be had here.
Yeah, and sometimes those can be revealing too, right? Like you see something that's priced well under market, and then ask your agent. Turns out in the supplements they're disclosing that hey, the porch needs to be raised and rebuilt because the city
Mhm.
decided that it wasn't permitted. Like when they added this porch on, like there can be underlying reasons why that number is set low, that aren't just a deal. It's that there's a problem, and you can kind of jump on it ahead of time.
Yeah. So I guess for the safety oriented pharmacist, if we want to try to wrap this portion up, the safety oriented pharmacist is definitely not wanting to overpay for a property, right? So the their own analysis of what are the comps can help with that, so that you can start to see what the trends are and are you buying above or below that trend line. You can also ask your realtor for some help to see if the realtor believes that that is above or below what the market value is. And then that appraiser can be your last line of defense, so that if you have the property under contract at $200,000 and the appraiser says, I think it's only worth 190, then that
Mm.
can be a nice stopgap to say, we need to renegotiate, or maybe I just don't want to buy this house. Maybe I'm overpaying on it.
Yeah, and I think no matter what, like that overpay, right? Making sure that you fully understand what goes into the appraisal process can help you make sure that you feel good about it, right? How many times are there cases where an investor wants to pay cash for a place? There is no appraisal involved in that, right? It's just
Mm-hmm,
you
mm-hmm.
offering cash and trusting your agent that they've got the value right. So it's important that as an investor you understand what goes into appraisal and not just rely on that as the only stopgap, because sometimes it's not there. And like we said, it's one opinion of value. It's an important opinion of value, but it may not be
Right.
the only one. So good clarifier.
Yeah. And really that creates then a jumping off point, because a lot of investors that are looking at single family residential or these 1 to 4 unit buildings are often looking to do some sort of value add, right?
Mm.
They're looking for a property that's maybe a little on the ugly side, and if you make it pretty, it can be worth more. Maybe you can update something. Maybe you can take something that's just not been kept up well and do a new furnace, water heater, roof, update the property, and increase the value that way. So a lot of folks are looking for those opportunities to increase the value. So it and really increase the value in a way where, for instance, a $20,000 renovation on a property would increase the value by more than $20,000, so that there's a positive return on your investment with a renovation there. So Nate, from that standpoint, what kind of things are you looking for, and how would you leverage the data points in this appraisal process to help with some of those next steps in analysis?
Yeah, it's a good question. I think that I've definitely seen cases where people put 20 grand into a property and don't get anywhere near 20 grand back out. Right there are
Mm-hmm.
things that are not value adds or are required basically for that property to function well, that don't add nearly as much as it costs to put into it. So I think a lot of times, and this can be an area where an agent can help, where you look at, hey, okay, the properties in this area are generally 2,000 square feet or above. If your property is 1,400 square feet and your bedroom size is really small, like maybe that's an area to think about. Like, okay, an addition here actually might make sense. It would really bring up the value compared to the other houses nearby. Similarly, if your property is already 4 bedroom and properties in the area that are 5 bedroom don't seem to be selling any higher, adding a fifth bedroom with an addition or something is not going to be valuable, right? It could cost you 100 grand or more to add this extra bedroom, and it might not be anything in terms of value, right? So you have to kind of assess what the neighborhood around you is doing before you can pull that trigger. It's different for every market and location.
Yeah, and there are a lot of really common rehab things to a house that an owner occupant might do just because they like it and they're going to live there and they want it to be their house. Like they might change the paint and flooring and things like that. But a lot of times, if the paint and flooring are in good shape before the renovation, if you put $20,000 into new paint and flooring, it may not move the price of that house, right? So there are dangers there where oftentimes investors end up looking for something that's really in pretty bad shape, so that those kind of improvements end up making a pretty significant change, right?
Yeah, I think it's a key distinction. I mean, as an investor, the goal is to make sure there's a bigger return on value based on the investment. Like that's the goal. Like you want to put less money in than you get back out of it. And so making that decision up front, like, I mean, David, you do this all the time. Like, do you have any good examples you can share with us on like what that actually looks like in practice?
Yeah, one just kind of Midwest example, because so many houses in the Midwest have basements.
Mm,
Hopefully, if you have a dry basement, one thing that people tend to do around here is to finish the basement, right?
mm,
So if there's 200 square feet of dry basement space and you're able to hire a contractor that can finish that for $100 per square foot, then for $20,000, you can finish out that basement area. And then I know one of the common metrics in an appraisal process or a BPO process is looking at what's the dollar per square foot of
mm,
finished space value that's created. So if you're in an area where your realtor tells you that there's $200 per square foot of value, and that $20,000 basement renovation would create $40,000 of value, well, then that's a $20,000 return on that $20,000 investment right away. If we're just looking at a value and equity standpoint.
Yeah, and it's not just about selling too, right? Because if you rent that property out, you could also increase the monthly rent, right? If a finished basement that somebody can use with a larger family or whatever, it affects the rent rate. Like that can be good as well. Now, I think we didn't mention this earlier, but we probably should drop this in here for a second too. Is that rent rate does not affect the appraised value. These are not
Yes.
being appraised like a commercial income property, right? So, like an apartment building is basically assessed on the income that it generates. A home, a 1 to 4 unit home, like we've been talking about, does not matter. Like it might help you in terms of like a debt to income ratio if you're refinancing or whatever, but it does not help you in terms of appraised value of that property, what the rent is generating.
Correct. Correct. So, and that is a really big distinction, because even though you're using it as an investment property and the rent matters to you, that's not a formal data point that factors into that appraisal.
There's actually a whole type of appraisal centered around that. It's called the income-driven approach, where you basically look at a property for its income-generating properties. Most banks do not use that for residential properties. It just doesn't make sense.
Yep, absolutely. And one other thing that might impact both the value and the rent would just be increasing the overall quality of the house, or the desirability of the house. So let's say that you find a time capsule house from 1974 that's still got the same carpet and the same wood paneling and all that. Maybe there's a way that you can bring it 50 years into the future and significantly change the cosmetics, and suddenly it's much more desirable. And that's where, if you're making a pretty significant change like that, you talked earlier about the C1 through C5 condition scale. If you can pretty dramatically change the condition of the house, that can change the value, both from an appraisal and a rentability standpoint.
And that's probably the one that people are most familiar with, right? That's like every HGTV special ever. It's like, I took this old gnarly house from the 70s and updated it, and now I sold it for a whole bunch. That's like everybody wants to do that. So yeah, I think that's probably the most common. We should have probably started there.
Yeah. Yeah. And another one is probably bedroom count, right? Like we've talked about that in the past too, where if there's an awkward family room back behind the garage or something, and you can add a door and a closet, suddenly that's a bedroom. Or if there's, so in some cases, there's a way to turn a single family house into a duplex, or a duplex back into a single family house. You can do some more advanced things there. Obviously, you need to look into zoning and codes and all those things, and make sure you're doing those kind of things correctly. But while painting a house and changing the flooring is pretty straightforward, there are some more significant surgical things that you can do too, if you're looking for more value add opportunities.
Yeah, definitely a plug for talking to your municipality and local zoning board before doing any of that stuff. But yes, definitely a good option for sure.
Yeah. So when we're talking about the value potential, then let's shift gears to our third point, which is understanding how you turn that value into an offer. So Nate, we started with that concept of how the list price might not have anything to do with value. And so with your realtor hat on, can you explain why a realtor might put a price on a house that's way above or way below its true value?
Yeah. So all of it is essentially, this is going to sound bad, but it's all essentially like a marketing scheme, right? It's all for the purposes of trying to sell the house. And there's lots of different reasons you could do it. I'll just name a few. I mean, if you want to try to get a property to move quickly, let's say, right? You want to get a lot of traffic. So you price it low. Now you get a ton of people through. You might even get that open house where like everybody's walking through and they're all talking about how much they love the house. And so everybody's like, I got to put an offer in quickly. And like, boom, it's going to sell quickly. And it's probably going to sell decently close to market value just because you've got all these people sort of flooding it at the same time, right? So that could be an option. You could also have something where people price it high and they say, look, I'm not that ready to sell this property, but if the right person comes along and if they offer me that or near to it, like done, I'll sell it, right? So those are sort of a realtor's nightmare, but they do exist where you can put it up there and it's 50,000 over market value. But if somebody offers it, like, all right, sure, I'll sell for that. The other one too is that sometimes you'll see people where like they'll stick with a number and they'll just lock it in, and it might just because they need to get that out of the property, right? Maybe they've refinanced it a few times, they're close to being underwater, they're barely going to make anything on this property, and so if they don't sell it for X, they're not going to make it out, right? So without having to pay anything, so you might get a situation where that value is sort of stuck for the seller. So it's again, it's all sort of made up, but there's always a reason behind it. It just depends on the particular seller and what their needs are in the moment.
Yeah. So it sounds like if it's kind of artificially high, eventually a lower offer may come in and eventually that may work out, which is the realtor's nightmare. If this house may sit on the market for 6 or 9 or 12 months, right? If it's artificially low, it might get bid up over that asking price. But either way, whether you get high offers on a low price or low offers on a high price, it sounds like it's generally going to wind up with an offer that's pretty close to market value in the end.
Ideally, right? There are states where you're going to be able to get a property for less than what it's worth, right? So maybe it's a situation where they priced it low, it doesn't get that same level of activity. You catch it and say, "Hey, I'll put an offer for that," and they're like, "You know what? Done. Like I want to be out from this house. Like I want to get out."
Hmm.
And so like you could get it under for that. The trick is that the problem is like getting it for a lot more than value, or as a seller trying to sell a property for a lot more than it's worth. It's really difficult. Like we said, we have the appraisal to kind of be that
Yeah.
extra stopgap. And so if you've got it listed at 100,000 over and you get somebody that's like, sure, I'll pay that. There might be a bank that says, well, I won't, and you need me to be part of this deal. So you're right. It's always going to sort of be close to value. It's hard to get it very far off of that true market value.
Yeah. So if there are some potential strategies to get it a little lower, like looking for something that might not be as desirable to a lot of people, kind of where we started off, if the house is cluttered or dated or somehow just not very desirable and there's not as many people looking at it, that might be an opportunity to get a house a little bit lower. But then some of those value add things that we've been talking about would be other things to look for in that, where it's even if I buy it at market value,
Mhm.
there's a pretty easy way for me to increase the value with a value add strategy. Is that right?
For sure. I mean, and it's something we work with our investors all the time on, is trying to say, look, how do we get this at, the value we're probably going to have to pay, but still make it a worthwhile investment.
Right, right. So if I was looking for like a 1,200 square foot 2 bedroom house in Cleveland that had a den,
Hmm.
where there'd be a way to just add a closet to a room that's not technically a bedroom, but suddenly overnight it's a bedroom. Now it's increased the rental value because 3 bedrooms rent higher than 2 bedrooms, and maybe even the property value because of the bedroom count. That might be more of an investor's criteria when looking at the market. And then I might be willing to pay the quote full market value for that 2 bedroom house, knowing that I can quickly convert it and increase the property value quickly.
For sure. And I think a lot of investors, depends on what your appetite for the work involved is.
Hmm.
Some are just looking at properties and saying, look, I don't want a property that I have to mess with too much. I want one where I can raise the rents, right? So find me one that's already rented out. It's a triplex with three
Yeah.
people in it, and the rents are under market, right? That's the value I want to add. Some are things like cosmetics, right? I want to fix little problems that have been neglected for a while, and then I can raise rents, and then it'll be worth more, right? It's different for everyone's appetite, and I think that's part of the challenge, and honestly part of the fun for me as a realtor that works with a lot of investors.
Okay. I like that. And then there's probably some safety check in there also of just because it's a property that is full of clutter, or just because it's a property that you walk in and it smells really bad,
Mm.
it doesn't mean that it's necessarily under market value. You still need to watch that value very carefully to make sure that this fixer upper is truly a deal and truly has that value add potential to it, right?
Oh, 100%. I mean, that's one of the biggest things we have to figure out is when we walk in, like, again, I just did this with a client recently where the property was listed at like 240, and area homes nearby were going in like 3 to 340. And so the question became like, okay, what do we need to do to like, fix this house up? Well, the house smelled
Hmm.
terrible. I mean, it was like smoke and like cat, and it was just awful the whole way through. So,
Hmm.
okay, now we're talking
Hmm.
about repainting everything, running an ozone machine, tearing out all the flooring. I mean, it was atrocious, right? So there's a cost to that. Um,
Hmm.
the roof needed to be repaired. Right, it had moss all over it. It had
Yeah.
areas where I'm sure there was active leaking. Okay, so what's a new roof cost? So like we start to step back and say, okay, we're at 240. We have $60,000 worth of work, let's say, based on our initial assessment. We build in another 10% fudge factor. Like, are we at that $300,000 anyway? We just haven't spent the money yet. And that's kind of how you assess that when you're actually walking into it.
Yeah, because a rehab like that brings inherent risk. There's sitting
Mm-hmm.
time where you're making the mortgage payment while you're doing that. Like rehabs can get very expensive very quickly. So yeah, it is important to know, like, is there enough of a discount in there to make that process worth it?
Yeah, I think that's the key, and that's what separates a good deal from a bad one.
Yeah. And I think then that helps with the offer factor then, because particularly if you're working with a realtor, they can help you to identify what's that final price once it's fixed up.
Mhm.
And they can help you with some of the estimates of what these things could cost. So you can back that down. And so in that case, the 240 house, like maybe the offer is 190, or
Right.
maybe the offer is 200 or 180 or something like that. And that's where, regardless of the list price, you can use the math and what it's going to be worth eventually to figure out what the offer should be today.
So funny story. That house we offered 205, so not too far
Nice.
off. We did not get it. Someone else came in and overbid us, and I think it hasn't closed yet, so I don't know what they're going to pay for it. But they way overbid us, and good luck to them.
Yeah. Yeah, and I've been there too. And I think with an investor hat on, you also have to get used to not getting every house that you offer on. And maybe that's even a good sign too, that if
Mhm.
you got every single house that you offered on, maybe that's a sign you're overpaying too. So if you're
Yeah.
going in lower, then you're a little more aggressive on that. And with an investor hat on, you may be valuing that differently. Like perhaps
Mhm.
there's someone there that they really wanted that house because it's across the street from something, or they're friends with the neighbor, or they were going to live there personally and they're not as worried about there being equity at the end of that equation. So, just because you missed out on an offer doesn't mean you did your math wrong. It just means you got to look for another house now.
Yeah, I think that's an important distinction. Like we one of the things I learned early on when starting investing was like you're going to see way more houses than you offer on, and you're going to
Mm-hmm.
offer on way more houses than you actually buy. Right? It's just there's not like I saw one and I offered on one and I bought one. It's like no, this is like a funnel approach. You have to get to the one you actually buy.
Yeah, yeah. I've heard investors say anywhere from maybe 10 to 50% of their offers get accepted and end up closing. So yeah, absolutely. Absolutely. And I think it's really important then to understand that difference between a property's actual real value, the value that it could be once it's fixed up, so that you can then make a really intelligent offer like that in a safe way.
And keep in mind too, I think one of the things that we don't talk about a lot is that there's a seller on the other side of this too, right? So I work with sellers that are in situations that vary dramatically in terms of what they want to do. And so we're talking about coming in and buying a place and trying to get a deal and trying to get it for as low as possible. That seller is on the other side trying to get as much as they can out of it, or trying to get out of a
Mm-hmm.
bad situation, or trying to sell the property quickly, or whatever. So like there's a whole nother side to this going on, that when we're making offers, we're doing it with our investment in mind, but they've got their own agenda on the other side of the table. That it's hard to always remember that and wrap your head around that, because it's not something we see.
Yeah, but it sounds like for one of many reasons why throughout the episode we keep talking about how a good realtor can help with this process. So, Nate, with that hat on, how would someone find a good realtor in their market?
Yeah, I mean, this is like a shameless plug, right? But we do have a free service that you can access for this. We've got the real estate concierge service, where we can connect you with a real estate investing friendly agent to help you out with the process. So if you go to yfprealestate.com, or even over to my website, realestaterph.com, the concierge service is linked there. Totally free service. We can meet, chat about your investment goals, get you connected with a really great agent, and get you off and running. So if that's something you're looking for, again, I'll end my ad here. But the goal there is to help you guys out. So if you want that free service, it's available to anybody that wants to use it.
Yeah, and really, I think as we've talked about the nuance in the data, how in some areas finished basements are cool, in some areas nobody has a basement, that's not even a thing. In some areas, 4 or 5 bedroom house is more valuable. In other areas, that's an unheard of thing. and it wouldn't make sense to do that in a neighborhood of 2 and 3 bedroom houses. So there's so much local nuance to that a local set of eyes and a good investing friendly local realtor can be really helpful.
Yeah. All right, guys. Well, hopefully that helps you get a little more idea on valuation and understanding how a value is determined. And now you can go out into the world and go evaluate houses just like any other agent out there. So go for it. Enjoy.
Thanks for listening to the YFP Real Estate Investing Podcast. If you like what you heard in today's show, please leave us a review and subscribe to the show so you never miss an episode. If you have a question, know someone that would make a good guest, or want to connect with us, head on over to yfprealestate.com and join the growing YFP Real Estate Investing Facebook group.
As we conclude this week's episode of the YFP Real Estate Investing Podcast, an important reminder that the content of this podcast is provided to you for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in this podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with their financial advisor with respect to any investment. Furthermore, the information contained in our archive newsletters, blog posts, and podcasts is not updated and therefore may not be accurate at the time you listen to it. Opinions and analyses expressed herein are solely those of your financial pharmacist unless otherwise noted and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer.
Thank you for your support of the YFP Real Estate Investing Podcast. Have a great rest of your week.